Okay, good afternoon, everyone. Just give me a second. Let me share the slides. Okay, I hope everyone can see the screen. So good afternoon, I'm Eileen from the IRAS GST division. And together with my colleague Lina, we will be guiding you through the key GST concepts on zero-rated supplies. So before we start, let me quickly outline what we will be covering today. So first, we will briefly run through what are the different types of supplies, whether is it taxable or non-taxable supplies. We will then focus on zero rating of export as well as international services. And at the end, we will end off with a summary on what we have learned. So do feel free to type your questions in the Q&A function as we go along, and we will address them during the Q&A session at the end of today's sharing. So let's start with the first section on supplies. First, it is important to understand what is a supply. So a supply is anything done for a consideration, including all forms of supplies and reverse charge supplies. So it can be in the form of providing tangible goods or provision of services. So anything which is not a supply of goods, but is done for a consideration is a supply of service. There are two main categories of supplies, taxables and non-taxable. So under taxable supplies, there are two different types of supplies. So when you sell goods or you provide services locally, these are what we call standard rated supplies, and you charge GST at 9%. Then we have zero rated supplies, which refers to the export of goods or provision of international services. So for this, GST is charged at 0%. The next category is non-taxable supplies, which are supplies where no GST is charged at all. So if you are earning interest from your bank account or you are selling or leasing unfurnished residential properties, these are what we call the exempt supplies. We also have out-of-scope supplies. So this refers to third country sales or sales made within the free trade zone. So as mentioned earlier, a zero-rated supply means that GST is charged at 0%, and there are two main categories of zero-rated supply: export of goods and international services. So for export of goods, there are three key requirements that you need to remember. First, the goods must physically move out of Singapore. Second, you must have proper documentation to show this movement of goods. And third, you must follow the time of supply rule, which is to say that the export must occur within 60 days from the time of supply. And for international services, for it to be zero rated, the services must fall within Section 21(3) of the GST Act. You also need to have clear documentation, such as the contracts and agreements, to show the international nature of the services. So it is important to note that just because you are dealing with an overseas customer, it doesn't mean that you can definitely zero rate your supply. You must ensure that all the conditions are met before applying zero rating. Okay, so let's now dive into zero rating of export. For export, you can zero rate your supply of goods if you are certain at the time of supply that first, the goods will be exported or have been exported. And second, you have the required documents to support zero rating. So there are two types of export, direct and indirect. Direct exports are when you have custody of the goods being exported and control over the export arrangement. So direct export may be zero rated if the required documents to support zero rating are maintained within 60 days from the time of supply. So indirect export, on the other hand, occurs when you do not have custody of the goods or you do not have control over the export arrangement. So for indirect export, you must treat the sale as local standard rated supply and account for GST at 9%. However, if the zero rated supply, you can zero rate the supply of the goods if the export scenario falls within the approved indirect export scenarios in paragraph 7 of our GST guide on exports. Okay, so now let's talk about the 60-day rule for export because this is really important. So as mentioned earlier, you have up to 60 days from the time of supply to export the goods and collate the required export documents. If you fail to do so within the 60 days, you will be required to standard rate the supply and charge 9% GST. So say for example, you receive payment for a sale of goods to be exported to Thailand on 2nd of January 2024 and issue an invoice on 15 January 2024. The goods were then exported to Thailand on 17 January 2024, and you obtain all the required documents by 30th January 2024. So in this case, you can zero rate the supply as everything happens within 60 days from the time of supply, which is 2nd of January 2024. An important principle that we wish to highlight is that if you cannot be sure at the time of supply whether the goods will be exported or not, you cannot zero rate the supply of goods, even if you obtain the required export documents thereafter. So a common example is when you deliver your goods to a local customer and your local customer tell you that, oh, I will export the goods and I promise to give you the export document showing you as the exporter. But as you supply and deliver the goods locally to the local customer, you should standard rate the supply even though the customer promised you that they will export the goods. Another example is when you sell the goods to an overseas customer and the goods are delivered and stored in the warehouse of the overseas customer's local freight forwarder, awaiting for instruction to onward deliver the goods to the overseas customer's customer, who may be in Singapore or overseas. So as it is unknown at the time of supply whether the goods will be exported, you have to standard rate your supply to your overseas customer. So generally, these are the basic documents you need to maintain for most of the export scenarios. For the full list of documents for each scenario, you can refer to our GST guide on export. There are also other guides you may refer to for specific scenario, such as the GST guide on hand carry export scheme for goods hand carried out of Singapore via Changi Airport, the GST guide for aerospace industry for supply of stores, fuels, and merchandise to an aircraft, and GST guide for the marine industry for businesses supplying or leasing goods that are used on board a vessel. Let me share a case with you that we encountered in the course of our work. We have changed the names and details in this case to protect the taxpayer's identity. So this case involved a company called Vicinity Private Limited, who is a manufacturer of derivative and intermediates. So here's the situation they faced. They wanted to zero rate a supply of resin to an overseas customer, but they couldn't export the goods within 60 days. Hence, they wrote in to us to seek the controller's approval to allow them to zero rate the supply. So the timeline went like this. On 3rd of February 2023, they had a purchase order from PT Ecoris in Indonesia for resin to be exported in 2 shipments. On 27 February 2023, they collected full payment from Ecoris. And in March 2023, Ecoris instructed Vicinity to export in early April 2023 due to issues with their import permit. And on 10th of April 2023, the first shipment went out and Vicinity issued an invoice to Ecoris with 0% GST. On 18 April 2023, Ecoris asked to delay the second shipment because their customs was closing for festivities. And finally, on 9th of May 2023, the second shipment finally went out and Ecoris issued invoice with 0% GST. So now if you recall the 60-day rule that we discussed earlier, the time of supply for this case starts from 27 Feb 2023, which means that the clock starts ticking from 27 Feb. The first shipment was exported within 60 days from 27 Feb 2023. But the second shipment was exported beyond the 60 days period. So can we still allow Ecoris to zero rate the supply? For the first shipment, we note that the documents maintained by Vicinity was relatively complete. They had the purchase order from the customer, the payment evidence from the customer, the invoice issued which makes reference to the customer's PO number, and stated that the goods are to be shipped via vessel A from Singapore to Indonesia on 10th of April. Vicinity's packing list also reflect the list of goods for export, information of the vessel, and departure date, as well as the customer's name and address. They also had the certificate of insurance to cover all risks on goods shipped on board vessel A on 10th of April. Lastly, the bill of lading showed Vicinity as the shipper and Ecoris was the consignee, and the goods were shipped from Singapore to Indonesia. For second shipment, Vicinity maintains similar documents as the first shipment, and on top of that, they also maintain the container acknowledgement slips and email correspondences documenting why the delay had happened. So based on the facts of the case, the controller agreed that the supply can qualify for zero rating on the following grounds. First, the export scenario is one of the approved scenario in our GST guide. Second, Vicinity maintained the required documents based on what is stated on the GST guide. And third, even though the second shipment was not exported within 60 days, there were genuine commercial reasons for the delay, and Vicinity could support this with documents from third parties. Okay, now let's move on to zero rating of international services. So before we go through, there are three key concepts you need to understand. First, is it under a contract? Second, who does it directly benefit? Third, and is it directly in connection with something? So first thing first, please remember that not all services provided to overseas customers can be zero rated. You can only zero rate your supply of services if the services fall within the provision of Section 21(3) of the GST Act. So this slide shows a quick overview of how the international services can be grouped into different industries. So for example, for logistic, travel, and related services, you can look at Section 21(3)(a), B, C, D, and H. For general provision that can be applied for multiple industries, you can look at Section 21(3)(e), F, G, J, and K. Some of the provision under Section 21(3) requires you to determine whether your services are under a contract with someone who belongs outside Singapore, whether your services directly benefit someone outside Singapore or a GST registered person in Singapore, or whether your services are directly connected to goods located outside Singapore. It is important for you to establish if the above conditions are satisfied in order to zero rate your supply. So let's start with under a contract concept. So you have to determine whether a contract exists, and this is really a question of fact. A contract can exist via a service level agreement, even a service requisition order, and even email exchanges that clearly set out your business arrangement with your customer. Next, determining whether your customer belongs in Singapore or overseas. Your customer is considered to belong in Singapore if they have a business or some fixed establishment in Singapore and nowhere else, or they are legally set up in Singapore with no business or fixed establishment in any other country, or they have establishment both in and outside Singapore, but the contracted services most directly used or to be used at the establishment in Singapore. So you may be thinking, how am I supposed to know all this about my customer? So for ease of compliance, you may adopt any of the following administrative guidelines to determine the belonging status of your customer. So first, you can verify with your customer directly. Second, you can get their written declaration that they do not have a branch, agency, office, factory, warehouse, or personnel in Singapore. You can also check the ACRA business portal to see if the customer is incorporated or registered in Singapore. And lastly, you can check for a Singapore address on their letterhead, website, email signatories, or business directories. So if you're in doubt, you should standard rate the supply unless your customer can prove to you that they belong outside Singapore. For individual customer, the usual place of residence is used to determine where they belong. So for ease of administration, we usually use the residential address as their usual place of business. So if there's more than one residential address, the individual may be regarded as belonging overseas if he is absent from Singapore for a continuous period of at least 1 year, excluding any temporarily return to Singapore for vacation. And the person stay in a fixed place in the overseas country, and he's working overseas because of an overseas assignment, and the overseas assignment must be related to the employment in Singapore. Okay, I will now hand over to Lina to cover the next part of our sharing.
Hello, good afternoon, everyone. Okay, my name is Lina. Thanks, Eileen, for covering the technicalities on zero rating of exports and also the technical interpretation for some of the conditions under international services. So for my segment, I'll be sharing 2 case studies to help you understand on how to apply the 2 most common international services that's under section 21.3G and also 21.3J. So hopefully once you are familiar with the thoughts process on how to apply zero rating, you can apply the same approach to other parts of section 21.3. Okay, so to qualify for zero rating under section 21.3G, you must satisfy all of these conditions. So for condition 1, the services must be supplied directly in connection to goods for export and supplied to an overseas person at the time the services are performed. So Eileen has already shared what is considered as directly in connection with and how to determine the belonging status of the customer. So for condition 2, the services must not relate to media sales. That is because for media sales, it has its own set of conditions that you need to satisfy, and that is already covered under section 21.3U of the GST Act. For condition 3, you must have clear intention to export the goods when you provide your services. And to prove this intention, you need to get a written confirmation from your overseas customer stating that the goods will be exported after your services are completed and what is the expected date of export. At the same time, you also need to maintain the export documentation within 60 days after completing your service. Okay, so what happens if you are an intermediary? So let's say your services is only one step of the whole supply chain process. So after your work is completed, the goods will be sent to another service provider for other value-add services before the goods are exported. Whether you can continue to zero rate the supply of service. So the answer is yes, you can zero rate your services to the overseas customer, but you need to maintain, you need to be certain that the goods will eventually be exported, and you must maintain additional evidences like written confirmation from your overseas customer about the final export plans and also what's the expected export date. You need to get details about the next service provider in the supply chain, and you need to get confirmation from this service provider that they will ensure that the goods will eventually be exported. Okay, so now we go through one practical case study to understand on the application of this section. So the background of these 3 entities involved here is VPL, that is a Singapore company providing marine engineering services, VAS, which is a Norwegian company supplying brand X pumps, and they also provide some related services. So for context purpose, VAS has no business establishment or fixed establishment in Singapore. Okay, then we have this third person, vessel A, which is an ocean-going vessel temporarily docked in Singapore for outfitting works. Okay, so what happened is VAS supplied an invoice vessel A for the supply of brand X pumps, and also to provide the corresponding installation works lah. But VAS didn't do this themselves. What they did is they subcontracted the installation works to VPL, which is located in Singapore. So VPL will do the installation works based on VAS instructions directly on board vessel A. So the question is GST chargeable on VPL's supply of installation services to VAS? Priscilla, can I get your help to show the quiz so that our audience here can key in their answer? What do you think is the answer? Is GST chargeable on the supply of installation services under Section 21(3)(g)? So if you look at the conditions under this Section 21(3)(g), do you think it can satisfy zero rating? Is GST chargeable? Is it A, yes, chargeable at 9%, B, no, not chargeable, not chargeable, is chargeable but charged at 0%, or is it C, no supply at all? Priscilla, can we have the answer? The answer is actually B. So GST is chargeable but charged at 0% lah. So, okay. Priscilla, we close the quiz. Okay. So, for this case, the correct answer is B. So we walk through each condition to understand why the services can actually be zero rated. So first we look at whether the services were they supplied directly in connection to goods for export, and whether it's supplied to an overseas customer. So since VPL performs the physical work of installing the pumps on board vessel A, VPL services is considered to have satisfied the conditions under directly in connection with goods. And also VPL need to establish if the services provided to an overseas customer, right? So for belonging status, I've already mentioned just now, VAS is incorporated in Norway and has no business establishment or fixed establishment in Singapore. So this condition is also treated as being satisfied. So next, under condition, the next condition, you look at whether there is a definite and immediate intention to export the goods when the services were being performed. So we know that vessel A is temporarily docked in Singapore for outfitting works, and then it will head out to international waters. So the vessel is considered international in nature, is meant for open seas and not for local use. So the intention to export the brand X pumps here is clear in this case. So it's also considered as satisfied. Okay, next, we look at the certainty that the goods will be exported. Certainty in this case is certain because VPL is not an intermediary service provider. They are the ones who did the installation works themselves on board vessel A. So they had control and they know for sure that the brand X pumps will be exported when vessel A leaves Singapore waters. And lastly, regarding media sales, so VPL's installation services were not related to any media sales. So this condition is treated as satisfied. So since all conditions are met, VPL services to VAS qualify for zero rating under Section 21(3)(g). Okay, so what happens if vessel A remain in Singapore for more than 60 days? So then VPL would have to charge GST on the installation works to VAS, or alternatively, if there are genuine reasons supporting their, okay, so what they can do is they can also write into IRAS to request for an extension beyond this 60-day period. But the request must be supported with valid commercial reasons and also documentation. Then we will consider, or we will take all this into consideration, and we can let VPL know. But generally, it should be within the 60 days period lah. Okay, so what documents should VPL maintain to support zero rating of the installation services? So it would be documents issued or maintained in the course of your normal business, things like agreement between the local company and the overseas company, to prove who is the person you contract with, your sales invoice for the nature of the services performed, evidence of payment, service report to prove that the work is done on board vessel A, endorsed timesheets to prove the actual work done, and most importantly is vessels A's departure date lah, to prove that the goods are exported and is within the 60 days period. Okay, I now have a second case study, but this case study is for application of section 21.3J. It's quite similar to 21.3G, but there are certain details that you need to look out for lah. So for section 21.3J, your contract must be with an overseas person. And the direct beneficiary can either be an overseas person who is located physically outside of Singapore when the services are performed, or a GST registered Singapore business. Then for this subsection, your services must not relate to any goods or land in Singapore. Your overseas customer must be physically outside Singapore when you perform the services, and the services do not involve media sales, which I've explained just now, should be under section 21.3U. So for the second case study here is involving two entities, that is Security Limited, an overseas security analytics software vendor, and also CyberSight, which is a Singapore-based tech company handling software licensing and hardware solutions. So what happened is Security signed a contract with CyberSight to engage them for two key activities in the Asia Pacific region. So the services involve pre-sales and also post-sales activities. So some information on the services that they conduct for both pre and post-sales activities. So for pre-sales activities, it involves doing some documentation work, doing some product demo to potential customers, as well as responding to potential customers' inquiries. But for post-sales services, it involves providing services to confirm clients, like doing maintenance or support services, and they cover both securities local and also overseas clients. So what CyberSight do is they will build security for the pre-sales services and also post-sales services. They also bill monthly service fee, but this is invoiced separately from the pre-sales and post-sales services. So what do you think? Do you think GST is chargeable on the pre-sales and post-sales services? A, yes, must charge GST for both services. For B, charge GST 0% only on pre-sales. C, charge 0% GST on post-sales. Or D, charge 0% GST for both pre and also post-sales services. What do you think is the answer? Priscilla, perhaps we can show the answer. Okay, the correct answer is zero rating can only apply to pre-sales services. Okay, we will go through the details why this is so. So the set of conditions under 21(3)(j) will apply for both pre and post-sale services. But for okay, so we go through one by one. First, we go through for pre-sales first, then we will go through for post-sales. Okay, so for pre-sales, for condition one, we ask ourselves, the services supplied, right? Is it supplied under a contract with a person who belongs outside of Singapore? So, as Eileen mentioned, whether a contract exists or not is a question of fact lah. So in this case, just now, in the background, I've mentioned that they have a contract, and also security is considered to have belonged outside of Singapore. So is considered as this condition being satisfied. Okay, for condition two, did the services directly benefit a person who belongs outside of Singapore and is outside of Singapore at the time the services are performed? Okay, so you may want to note here that from 1st of January 2020, the scope has also been extended to those directly benefiting GST registered persons lah. Okay, so for this case, when we look at direct benefit requirement, what we can do is to look at the contract. So if you look at the contract and the contract states that the pre-sales services supplied, for example, in this case is into security, right? It indicates security as the direct beneficiary, then your answer is there lah. Then we also examine the flow of the services. So for pre-sale services, Cybersite provides marketing, presentations, and also product demo and responding to potential customers' inquiries, right? So although potential customers may benefit from the product demo and the information that they get from Cybersite, potential customers are considered as spin-off beneficiaries. So this indicates that security is actually the primary beneficiary of Cybersite services lah. So we will treat this as being satisfied. The third condition, were the services performed directly with goods or land situated in Singapore at the time the services are performed? So for Cybersite, although they might use securities hardware to do the product demonstration, the hardware is considered as a tool in order to deliver the service. So in this case, Cybersite services are not treated as performed directly in connection to goods situated in Singapore. Lastly, Cybersite services do not involve media sales. So since all the conditions are satisfied, that's why for pre-sale services is treated as qualified for zero rating under section 21(3)(j). Okay, so now we will look at the post-sale services using the same set of conditions. So for the first condition, because it's under the same contract for pre and post-sale services, right? So this condition automatically is considered as satisfied. For the second condition, Cybersite's post-sale services that includes doing maintenance and support services are provided to securities local and also overseas clients. So in this case, the direct beneficiary of the services are both situated local and overseas. Condition 2 is not satisfied. Okay, and also because it involves things like installation of hardware done on site in Singapore for the local customers, condition 3 is also not satisfied. For media sales, Cybersite services do not involve media sales, so that part is okay. So in this case, for the post-sale services, it cannot be wholly zero rated. Because the post-sale services is attributed to both standard rated and zero rated portions. So what Cybersite can do is they can consider to use an administrative concession to fairly split the two nature of supplies using a reasonable method. Okay, so where the supply of services are directly in connection to goods or land situated both in Singapore and also overseas, or it directly benefits both local and overseas customers, you can apply apportionment such that you only standard rate the portion that does not satisfy zero rating, but you have to use reasonable proxies, and the reasonable proxies are those that are listed here. One thing to note, you must keep records of the proxy that you have chosen and the details of the transactions, including how you calculate. So you would have to produce this when being requested by IRAS during an audit. Okay, I'll end off my presentation today with highlighting some of the key risk areas for zero rating for export of goods and international services and share some of the best practices to apply. So for export of goods, the common pitfalls that we observe during the course of audits are things like documentation issues, such as when we request for documents, some of the businesses come back to tell us, oh, I have missing documents or the export documents are not complete. So then you may risk having these transactions being standard rated. Or sometimes you have the documents, but it shows that the export is done after the 60-day period. Or you have documents, but it's not sufficient to prove the delivery of goods overseas, or the details in the documentary evidence do not match the actual goods exported. So you have to make sure that all the documents are complete and tie to the transactions that you perform. Okay, then there are also risks if the goods are delivered locally but incorrectly reported as exports. So this will usually happen because there's inadequate tracking of goods movement. So you must be careful on this part. For international services, some of the key areas that you need to be aware of is customer classification. So you need to make sure you remember to verify the belonging status of your customer. Then you don't assume that, oh, just because I provide the services to overseas customer, then it auto qualifies for zero rating. We don't look at it that way. You still need to look at all the other conditions under section 21.3. So section 21.3 has many different parts, right? You have to see which subsection applies to the services that you provide. So then, like for example, you have identified section 21.3J, then you have to look at the conditions under section 21.3J, whether you satisfy each of the condition components or not. Okay, another risk area for international services is wrong classification of service due to incorrect interpretation of the service category. Like for example, if you provide logistics services, then you cannot look at section 21.3 conditions for media sales. So you must identify the correct subsection under 21.3. Or for international services, there are gaps in the documentation. So things like maybe don't have contract or poor record keeping showing the service delivery. So certain conditions like just now, section 21.3G, you need to know the details of the exported goods. So all this you must be mindful that you have all the documents and information correct, because failure to ensure all this will have a risk that your transactions might be standard rated. Okay, so the practical solution to address this risk is to implement a robust control and also regular reviews of your transactions. So for export of goods, you can come up with clear export procedures, come up with step-by-step documentation requirements. Then you set timelines for your staff when they should collate all the documents, by when. You must make sure that it's within 60 days. So you set those kind of guidelines and procedures for your staff to follow. For document management, you can consider to implement a systematic filing system and also reconciliation process. Like your staff must be able to identify exports by air. You must maintain airway bill. For exports by sea, you must maintain bill of lading. So this must be clear right from the start. Then after you implement this documentation management, you also must regularly review your export documents lah. Make sure that you maintain the full set in order to qualify for zero rating. Then also you have to ensure that your staff knows what are the requirements for zero rating. So for staff training, you can either send them for courses, or your staff can also refer to IRAS website for information on GST and download IRAS GST e-tax guides. So staff, they must be familiar with GST information, particularly if you are in specific business industry where there are unique documentation requirements or conditions that you need to satisfy. Then there must also be compliance monitoring by conducting regular checks and review of high-risk transactions. For international services, we recommend implementing a review process to make sure that there's systematic document review procedures, review your contracts regularly, and set clear documentation requirements. Perform regular checks on your existing customers to verify their status, because sometimes all these overseas customers, suddenly one day they set up a business in Singapore, then they no longer qualify as overseas belonging status. So it's best if you can monitor from time to time on their business presence and make sure that you have your checks documented to safeguard yourself. Again, training of staff on zero rating requirements and up to date on IRAS and stay updated on IRAS requirements lah. So one of the things that you can consider to do is to subscribe to IRAS e-alert on our website to be updated on the latest GST updates. You can also develop a control framework with clear guidelines on zero rating assessment, document requirements, and conduct regular compliance checks. So we hope that with these tips, it will help to benefit your business and help you to avoid making errors on zero rating of exports and international services. So I urge you to visit our website where you can find detailed information and guidance on zero rating. Okay, with that, I'll pass over the session to Priscilla for the next segment. Thank you.
Thank you, Eileen and Lina, for the informative sharing. Next, I would like to invite Mr. Richard Ong, Partner and Head of Goods and Services from RSM, who will be sharing more on practical considerations on zero rating. Richard, please.
Hey, hi, afternoon, everyone. Thanks for joining us for this session. And also a big thanks to Eileen and Lina from IRAS for sharing on zero rating for goods and services. Do allow me to load my screen on the slides. Okay, just to also share about some administrative areas. Before I comment on my sharing, if you can see, there's a chat function on your screen. I will appreciate your help to use that chat function now. This is probably the only opportunity you can use that. Key in your chat function on a score of 1 to 10. 10 being I'm very confident that my zero rating applied on my goods, my services. I'm the least confident. Obviously, I hope none of us keen one. Okay, keen in your chat function. 10 being I'm very confident. 1 being I'm the least confident. Even after hearing from IRAS or after being in practice for so long, trying to file your GST return. Yeah. I hope we can see more closer to 10. Wow. I believe today's participants pretty humble. I see quite a number of you sticking to 5, 6. Not a lot read yourself 10. Well, someone rated himself or herself 11 out of 10. Well, that's good news, Eileen and Lina. Yeah. Okay. Okay. We shall stop that Thanks everyone for hitting your scoring. I'll be doing, including some aspects of the practical areas that I'll be sharing. You could upgrade your grading. Hopefully, none of us downgrade our grading to closer to 10. Okay, let's move on. This will be the areas that will be going through. Particularly, I think the key area for goods would be the 6 key points to consider. Obviously, not forgetting, I will also be starting off touching a fair bit on free trade zone and zero GST warehouse. And it's, I think, quite relevant since there are a couple of questions that you guys have raised relating to free trade zones and what we call bonded warehouse, which is now renamed or termed as zero GST warehouse. Okay, that will be the first segment I'll be covering. Then I'll be obviously also going through some key areas from a service perspective, particularly if you are keen or you would like to know whether zero rating applies on the services that you are charging your customer, or in some cases, we have also seen questions raised on related parties. Yeah. Okay. As a start off, I always would like to bring us back to this thing called the GST value chain. I believe most of us probably would be able to fathom. For a value chain to exist, the GST registered business must be there, and that would include you and me, all of us here. Since we are in a business and we are GST registered, there will obviously be costs that will incur in the course of furtherance of our business for making of taxable supply and out-of-scope supply. And that will be where we would have GST incur, and input tax will be claimable, subject to also meeting certain conditions. For those of us who are potentially not fully taxable, input tax needs to be apportioned. Okay. Next, most of us, as we also would agree, in the business, we want to survive and make profits. There will definitely come a situation where supply will exist as well. So if you were to make a supply, particularly supply that is taxable, output tax will be payable either at the current rate of 9%, or when zero rating applies, that will be 0%. Okay, I hope this will give us a good overview before I move on. I will first start off with the goods segment, particularly if you have heard from our so-called speakers from IRAS. They have touched on, from a goods perspective, the key area will be to look at this focal point on the place of supply. And for simplicity, I'll call it the ship from and ship to address. But I would also like to emphasize most clients and participants that we spoke to are also not very familiar that Singapore actually excludes, or what we call Singapore customs territory, actually excludes the two main key areas that you see on screen now: free trade zone and the zero GST warehouse. Okay, obviously, the Singapore customs territory will be where if you were to make a supply, you'll be taxable at 9 or 0%. For 0% to apply, generally, we need to prove that the goods are indeed exported with the transaction and transport documents. What is perhaps not so clear to some of the participants and clients that we spoke to, for free trade zone, generally, if the supply occurs within free trade zone, particularly this applies to overseas goods that are imported into free trade zone where import GST is suspended. And if that supply of goods, overseas goods, occurs within free trade zone, is disregarded for GST purposes. Okay, so this is something which I believe most of us might not be very clear. Obviously, if we bring local goods and supply within the free trade zone itself, you will remain taxable. Okay. Next, the zero GST warehouse, what we commonly known as bonded warehouse in the past. Similarly, these are areas where if your goods are being supplied within the zero GST warehouse or from one zero GST warehouse to another zero GST warehouse, that's disregarded for GST purposes. And to also perhaps bring us into the loop, for zero GST warehouse, generally it cannot be used to store durable goods, locally acquired goods, or locally manufactured goods and GST paid goods, as you can see on the footnote there. But what is slightly different from the free trade zone, like what I mentioned earlier, for goods transacted within free trade zone or even exported from free trade zone, that's disregarded for GST purposes. However, for goods that are exported from zero GST warehouse to overseas, that has to be tracked for reporting as your zero rated supplies under box 2. That is for movement tracking purposes. Okay, so this is something which I believe you will help align us along the way, as there's one question that has been raised on cargo that come into the free trade zone or zero GST warehouse. Okay, and I thought it's also good for me to answer one of the questions that has been raised as regards supply of goods that occurs within the free trade zone or bonded warehouse, assuming if the overseas goods are imported into free trade zone or zero GST warehouse, and we can prove that the transaction, including the title risk and ownership of the goods, are transferred within the two mentioned areas that we discussed earlier, that would be disregarded for GST purposes. Okay, so I hope that helps. With that, before we move into the next segment, I would like to quickly also get you to go through a poll. As you can see on screen here, hi SPF, I need your help to launch the poll. Okay, according to my current understanding, the 60-day rule would apply for A, B, C, or D. I believe you have listened carefully to what Eileen and Lina has shared. This should be a walk in the park. Okay. I hope no one chose none of the above. Okay. Yeah. And to narrow down the choice, it does not apply on job shipment of goods. So it's either supply of international service or export of goods. I believe we can stop the vote and show the correct answer. Yeah. Okay. Yeah. The correct answer is the 60-day rule applies on export of goods. Okay. So there's no 60-day rule for international services. Thank you, SBF. I hope you have got it right. Okay, let's move on. As part of my sharing, I also thought it's good to summarize these 6 key points that we have heard earlier from the IRAS sharing as well. In short summary, the determining factor for supply of goods, particularly we heard a lot from clients or participants, we need to look at the bill to party, we need to look at who sent us a PO. Actually, all these are not the correct reference point. You need to first I would say first and lastly look at the ship from, or where the goods are shipped from and where the goods are shipped to. That will determine whether you should consider your supply of goods as an export, as a local supply where 9% applies, or as a drop shipment or out of scope supply, assuming if the goods are shipped from overseas to overseas. Okay. Next, the time of supply will also be critical, particularly for standard rated supply as well as your export of goods, because this will determine the time frame where the supply that you make will be tracked for GST reporting. Because if the time of supply occurs in situations where you receive an advance payment today, but the invoice will only be raised, let's say, 1 month down the road, today you have to track it for GST reporting already, assuming that is a non-refundable payment that you receive from customer. Okay. Obviously, time of supply will also lead us to this important point, which the poll question that we went through earlier, the 60-day rule. particularly for export of goods, which our IRAS speaker have shared earlier. Apologies, I have some. Okay, so next, we have to also consider whether the goods are directly exported by us or is a indirect export. Particularly for indirect export would be situations where we do not have control over where the goods will go after we hand over the goods in discussion to another party locally. And in those situations, more often than not, if we do not have control on where the goods go, whether you will still stay in Singapore, whether it will be exported, then in those situations, you might not be able to apply zero rating. Obviously, to back us up on the nature of supply, whether it's standard rated or zero rated or out of scope, the transaction and transport documents that were shared by IRAS as well are pretty critical. There will also be situations where you could have a full set of documents, but if they do not talk to each other, okay, there is no connection point, and we can't match the fundamentals of the nature of goods that we are talking about. Then potentially, even if you are sure that the goods are exported, or you can swear that the goods are exported, zero rating may not apply as well. So these are the 6 key points that I urge all of us to give it a thought through as regards to supply of goods when we are trying to determine whether the tax code of 9% or 0% or out of scope applies. Okay, so far so good. Yeah. If it's okay, I need your help to use the chat function again. If it's so far so good, just key in good in the chat function. If it's not so good, just put can you slow down a bit, or you can use stop. Okay, thanks. So far so good. Thank you very much. Thank you. Okay. With that, I like to bring us through 3 common export or sale of goods scenario that we commonly observe that clients are making mistake or may not be too sure about. Okay, the first point that we'll be covering, or first illustration that we'll be covering, will be this thing called export not by way of sale. I believe one of the participants has raised this question earlier, and we cannot be more sure by looking at the illustration that I'm going to show you here. Okay, first, there's a timestamp, 1st of June. Okay, company A export goods under consignment to its customer designated overseas location. Okay, that is the first timestamp. Obviously, the customer will then use the goods according to their needs at different time frame. So at the point of the export, there is no sale. So for this situation, I believe most of us will not track it as our revenue. But for GST reporting purposes, again, you can use your chat function. Do you think we need to report it as our export? If you think it's yes, just click yes. If you are not sure, just indicate as no in your chat function. Oh, wow. See, a combination of yes and no, but majority of us indicated as yes. Okay, let us also quickly show you the answer. Those of us who have indicated as yes, well done. Okay, although it's not a sale or revenue, because at this juncture, there's no sale or revenue that occurs because customer has not utilized the goods and you will not be able to bill them. But for GST reporting purposes, okay, we need to track this export movement as zero rated under box 2 of our GST return. And at that point, the documents, obviously I can't name all, okay, documents like your commercial invoice or shipping invoice, the instruction from your customer to ship the goods to their designated location overseas, your export documents, if it's via airplane, it will be the airway bill, or if via vessel, will be a bill of lading or seaway bill, and your export permit. This will be what we call primary and critical documents that we need to maintain to substantiate that the goods are indeed moved out overseas. Okay, that's first timestamp. The second timestamp on 8 August 2025, okay, Company A got the notice from the customer that, oh, we have utilized the goods. Can you invoice now? Okay, invoice us now. So Company A raised that invoice to the customer. So I believe at this juncture, most of us will agree a revenue or a sale has occurred. So for GST reporting purposes, again, using your chat function, do you think there's a need to report for GST reporting purpose as a zero-rated supplier again? Again, in your chat function indicate as yes, you think is yes. If you don't think and GST reporting is necessary, just indicate as no. Oh, I believe this point, not a lot of us are very sure. And unlike timestamp 1, 1st June, I believe most of us got it correct. Okay, let us also quickly show you the response. Point 1 is a revenue and a sale. I believe most of us would agree. But at this juncture, okay, there is no GST reporting required because if you remember what I shared earlier, the 6 key points of supply of goods, the first one will be shipped from and shipped to. At this juncture, the goods are already overseas. Okay, they are because it was shipped to overseas location on 1st June 2025. And at this juncture on 8 August 2025, 2 months later, goods are already in the overseas location. And at that juncture, the sale took place. Okay, and from a ship to address, the goods are in overseas and it's shipped to overseas. And assuming we can prove that the goods are transacted overseas at that point in time, when the time where we make that sale or we make a supply, GST reporting is no longer required. Okay, I hope that helps. Unfortunately, I think most of us perhaps are not so sure on this area. So this is one key point where, like I mentioned earlier, a handful of our clients are not very sure when it comes to GST reporting. Should this similar scenario applies to your business? Okay, I hope that's good. Next, export on behalf of overseas principal. Again, there's also a very relevant question that was raised earlier on this, and I would like to quickly go into the illustration. Okay, no worries, you will have your chance to use the chat function. Okay, an overseas principal of your customer sends goods for value add or repair services to company B. Okay, now in the shoe of company B, after performing the value add service, okay, obviously you will raise an invoice, right? You won't provide the service to the customer for free unless it's under warranty, or if not, you will raise an invoice for the value add or repair services. And that value add or repair services, you will then raise it to the overseas customer, assuming these are relating to goods for export. Okay, and the contractual party, beneficiary party are the overseas customer. The service aspect will be zero rated. But most of us also may not be very sure. Do I need to also include the goods value when I return the goods to the customer after I provide value add services? Okay, meaning on top of the value add services that you are raising an invoice, obviously if it qualifies for zero rating as an international service, you report it as your zero rated supply under box 2. But what about the goods value? Again, using your chat function, do you think the goods value has to be added as part of the zero rated supply on top of the service fee? If your answer is yes, just click on the chat function yes. If you are not too sure or you think it's no, just click as no. Oh, okay. Most of us, oh, I believe this is probably something which Eileen and Lina may not be too happy when you see this. From IRAS perspective, again, I believe, let me quickly also, thanks everyone for your response. Let me quickly also show you what needs to be done. Okay, again, is to help us understand what is necessary. I believe from the chat function, most of us are not very clear. that we need to also include the goods value in this instance. Okay. Obviously, point one, where we raise the invoice for the value add repair services, most of us are very clear, and we will track it for reporting under box 2, assuming it qualifies as an international service. But do not forget as well, because the overseas principal or customer that you see on screen here, they send their goods in for repair value add, you're importing on behalf. And thereafter, you are returning the goods after your value add or repair services. So you need to add the goods value as part of your GST reporting. And that goods value can be either the OMV, the open market value, or if you do not know the open market value, look at the import value that is reflected on the import permit. Okay, so this is very critical, because if we miss out on the goods value, potentially you could have an incorrect reporting position or in your GST return. Yeah, I hope this is good. If it's good, just indicate in your chat function and say good. If not, I will not continue. Okay. Thanks. Well, lucky none of you say not good. Wow, terrific some more. Thank you very much. Okay. Next, last illustration about hand carry goods. I believe this scenario do not often occur, but I will say on and off, we do hear feedbacks from our customers, and this is a real case of a customer. Okay, just want to quickly show you the illustration. Okay, a customer of ours. Okay, they bought some goods from a local vendor, and these goods specifically they just to share, they are laptops that Company C. Company C is this scenario is real, but I have put in phantom names so that you will know who. Company C is our customer who approached us and said, "Oh, Richard, tell you something. We bought laptops from a Singapore vendor. They charge us GST. Can we claim GST or not?" So I was asking, why do you have this question? So my response to them would be, first, you have to probably answer the question whether you satisfy the input tax claim conditions. Okay, and after going through with them, it appears that they satisfy. So I told them, okay, it's claimable. But then I was also asking as a follow-up question, what are you going to do with these laptops? Oh, they say, oh, very interesting, because we just set up offices in Malaysia, in Thailand. So just to also share with you this juicy news, we bought this laptop. It's cheaper than buying them in Thailand, in Malaysia. So I was oh, okay, I didn't know. Laptop in Singapore is relatively cheaper. Okay, so since they are going to this Malaysia, Thailand office, okay, new office that they set up, some of them hand carry those goods out of Singapore. Okay, happily. Okay, and they told us, okay, we have raised an invoice, we have transferred assets, etc. and whatnot. But however, we also have reported them, because we know for any hand carry goods out of Singapore is zero rated, or we have to track it as zero rated. So my response to the client, which is Company C, would be, oh, okay, that's interesting. First, I didn't know laptop in Singapore is cheaper. Secondly, how do you hand carry the goods out of Singapore? They say, oh, we just hand carry, put in our bag, go through customs, they never check us, we just bring it out. So the question then would be, is the zero rating that they apply correct? Okay, again, using the chat function. Do you think that they just purely just put in the bag, walk through customs, assuming nothing happened, and they can zero rate in the invoice that they raise to the related company? If you think that is correct, just indicate your chat function to put correct. If not, then just indicate in the chat function to say no. Yeah. Yeah. Well, I believe this is relatable to most of us, because I believe most of us indicated as no. Well done, everyone. Okay, so I told them, oh, okay, you zero rate just by walking through. Can you teach me how? Because I also want to be invisible without being caught. So generally, if you want for hand carried goods situation, obviously the hand carried goods guide that is available on IRAS website would tell us what to do, and offer obviously my client is not aware that there is this guide and the conditions. So I told them, okay, in order to zero it, as you can see on the footnote on your right, you need to have the invoice raised, which they have. You need to have your export permit declared with the digital clearance. Obviously, we need to bring the permit together with the goods for customs examination or inspection at the point of leaving Singapore Changi Airport. Okay, this only applies for Changi Airport. Okay, and we need to have the payment evidence. In the conditions that I mentioned earlier, obviously client has the invoice and the payment evidence, but unfortunately they are not aware that an export permit with digital clearance as well as bring the goods and the permit for inspection are necessary. So we have also told our client, unfortunately, this triggers an incorrect reporting, and you might not be able to go back in time to re-declare those permit to go and get it validated or checked by customs. You might not be able to zero rate this particular supply. So again, while it does not occur on a frequency basis, should this happen to you, do take note, and it's not just restricted to laptops. Whatever goods that you intend to hand carry out from Singapore to your overseas customer or related company, for zero rating to apply, the condition, the specified documents that have shown on screen would be relevant and is necessary. Okay, I hope that helps. Yeah, so far so good. Okay, if that's fine, let me quickly also transit on to services. Similar to goods, these are the two main areas where we need to be aware of. Okay, unlike goods where the supply of goods, particularly overseas goods within free trade zone, are disregarded, for services made within the free trade zone, they are still taxable at 9% generally, unless zero rating applies under section 21(3). Okay, I will obviously and definitely not go into the details of the section 21(3), which earlier the IRAS presenter has shared, but do take note, for services that occur within the free trade zone, they are generally taxable at 9%, unless we can find something within section 21(3) that applies to us. Okay. Similarly, for services, designated area would be applicable in the same light as free trade zone. Supply made within designated area would be taxable at 9% unless zero rating applies. Okay, just to also give you a flavor on where the free trade zone is in Singapore, I believe most of us would know, particularly those of us who have sons who have served the NS. Opposite the Changi Jetty, where most of your sons take the boat to Tekong, you'll probably see a facility called the Alps Airport Logistic Park. That's a free trade zone. Okay, and designated area, I believe most of us will also know. A good example would be Jurong Island. Okay, you have not been to Jurong Island, just use a telescope to look from far from some of the high buildings along the coast area. You'll be able to see how majestic Jurong Island is. Okay, so far so good. So these are the two main areas that would also we need to take into consideration when we make a supply of services. Yeah. Okay. Before we move on to the proper sharing, I would also like to seek SPF help to launch the second poll question. Okay. For a GST registered business to apply zero rating, i.e. GST at 0% on its supply of services, it needs to know A, B, C, or D. I believe, again, if you have listened to what our IRAS speaker have shared earlier, the answer would be a walk in the park. Okay, definitely none of us will choose none of the above. Okay. Okay, so far so good. I hope most of us have voted. Okay, SPF, like you help to share the correct answer. Okay, I believe most of us have elected option B, whether Section 21(3) of the GST applies to its service nature. Okay. Thanks, SPF. Yeah. Let's quickly move on. Okay. Similar to goods, from a service perspective, there are also 6 key points to consider. In fact, I've been relying on these 6 key points as a reference point when I talk to my clients, when I ask myself whether the supply of service in a particular situation or scenario would be taxable at 9, 0, or 0%. Okay. First, we need to ask ourselves, who is the supplier? Obviously, if the supplier is GST registered and have business and or fixed establishment in Singapore and is providing services here, then that will be taxable. Okay. However, if the supplier is someone who does not have BFE in Singapore for GST purposes, then potentially that could be not subject to GST because it's outside the Singapore GST regime. Okay. But that could be imported services application. Okay, so who is the supplier is very key. I believe most of us would have what we call business and or fixed establishment in Singapore, and when we are providing services, a key point to take away here is generally most of them will be subject to 9% GST now. Okay, next key point, the belonging status, which I believe Eileen has also shared earlier. Belonging status refers to the fixed establishment and or business establishment of the supplier. Obviously, we must not also forget the fixed establishment and or business establishment of the customer for certain zero rating conditions under Section 21(3). Okay, we'll also be looking at some examples later, so do not worry. The nature and type of service would also be important. We do come across situations where when we ask our clients, hi sir, ma'am, do you know what type of service are you performing? They'll be pretty unsure. I think I'm selling goods and service. I think I'm so this will be situations where then it becomes very hard to determine because as a business, if you're not familiar with the type of supply or service that you're making, then it makes it very challenging. Okay, so you always have to ask yourself, what am I supplying? Is it a goods or is it a service? Particularly if it's a service nature, what type of service are we doing? Okay, is the service directly benefiting the contract party? Because again, if you have also heard from Eileen, the speaker from IRAS, the direct beneficiary could be the same party who signs contract with you, or it could be another party. Okay, we need to then look at the contract as well as the flow of service. To quote you an example, okay, today Richard could sign up a spa package, okay, with a spa service provider. Obviously, I am the contractual party with the spa service provider, but I might not use that spa service. I will then say, okay, those of you who answer correctly today, you will get a chance to win the one session of spa service with let's say Banyan Tree. Then who is the beneficiary? I believe you will agree with me that Richard will not be the beneficiary of the spa service. It's you who receive the spa service or that you won during the quiz from Richard will be the direct beneficiary. So these are areas that you need to ask yourself, who is the direct beneficiary when we decide to raise an invoice for services provided. Obviously, the directly in connection with will also be applicable for certain portion of the GST Section 21(3) when we come in terms of whether our service performed would be an international service per se. Okay, and last but not least, where is the service performed? We do also come across situations where clients are very unsure. They were sharing with us, oh, my service are performed overseas. There is no GST because GST only applies for services performed in Singapore, which is not really correct. Okay, there are also clients who told us, we perform services in Singapore. This definitely will attract 9% GST. Again, partly true, but there will also be situations where you perform services in Singapore, particularly should specific segments of Section 21(3) applies, that could also be applicable at 0% GST. Okay, so these are the 6 key points or touch points areas that I believe will be helpful in our determination. Okay, so far so good? Yeah, good. If good, then let's move on to the 3 scenarios that we will be showing you today. Okay, again, management support, you can also say recharges, or you are I would say a procurement center here. You're providing management support, accounting support, etc., which is quite common. Okay, and most of us as a GST registered entity here with BFE here, meaning we have officers here, our staff are here. Okay, imagine yourself now working for company D. Okay, and you sign a contract with your related company, okay, or to provide management support services. Okay, so far so good. And generally, when most of our clients see this flow, they will say, Richard, this one a straight international service, no question about it. Do you agree or do not agree? Or in this scenario, before I show you the rest of the facts and points, do you think it's a straight 0% international service? You think it is definitely yes, just in your chat function, indicate as yes. Otherwise, click no. Okay, well, I believe most of us are more expert in services than goods. Okay, I see a lot of no. Very good. Okay. Thanks everyone for your response. Let me also give you more facts. Okay, the company, this subsidiary that you see on screen here, more facts includes this is just an investment holding company. Okay, with no office. Okay, just a PO box, or as well as no human and technical resource to receive the service, meaning it's just a shell company. Okay. To second point, since it has no one there, okay, its main seat of economic activity, i.e. the management decisions, how to run the company, the directors, etc., are all located in Singapore. Okay, so with this additional facts, okay, just to also seek everyone's help again, do you think company D, when providing management support services to company D, subsidiary, could apply 0% GST with these facts that you've seen on screen? Yeah. Again, in your chat function, click yes. You think it's yes. Wow, really, this, I believe most of us are more expert in international service rather than goods. Very good. Okay, I see a majority of us indicated as no. Okay, so to facilitate us to make a better decision, I'd like to refer us to this particular segment of the GST Act called Section 21(3)J. Obviously, on the screen, you will see 4 conditions. First condition, services supplied under a contract, okay, with a person who belongs in a country outside Singapore. Again, based on what we already know, based on the facts that you see on screen, I believe we may not be able to satisfy this because company this subsidiary, although they are overseas incorporated entity, they don't have office, they don't have human technical resource, even the management control are all in Singapore, then unlikely they will be considered as someone who belongs outside Singapore. Okay, the direct beneficiary here, again, company this subsidiary will be the direct beneficiary, but this point 2 also says it must benefit a person who belongs outside Singapore and is outside Singapore at the time the services are performed. So again, condition 2 not applicable and does not apply as well. So what about condition 3? Okay, services performed directly in connection with goods or land outside Singapore. Again, in Singapore, again at this juncture, there is no goods or land in discussion. So obviously, we will be able to satisfy this condition. And last but not least, services do not involve promulgation or supply a right to promulgate an advertisement. Again, we are providing management support, and assuming there's no advertising content related services, again, these services will be, this condition will be satisfied. However, if you look at section 21(3)(j) that you see on screen, there are four main conditions. Okay, so long as any of them we are not able to meet or satisfy, zero rating will not apply. So in this scenario, should we raise an invoice, zero rating does not apply. Okay, again, it's also quite common because recently we have a client who has been audited by IRAS and on this scenario, and client is also very puzzled why zero rating do not apply, even though they are billing to an overseas entity. Obviously, they have not gone into the details to consider the facts that it's just a shell company and they have not evaluated against section 21(3), particularly 21(3)(j). Okay, so far so good. Okay, let me move on. For those of us who have questions, please indicate in the Q&A function. Okay, the chat function is only for you to vote only. We will not answer your questions if you put it in your chat function. My apologies. Okay, let me quickly move on to the next scenario. Okay, for services performed overseas, again, most of us would always think, oh, services performed in Singapore, definitely 9% apply. For services that perform overseas, definitely no GST apply. It may not be true, or to add things, to make things more complicated, most clients will also say, oh, if I'm performing services overseas, so long as I'm billing a Singapore customer, definitely cannot run, must pay 9% GST, must account 9% GST. Again, these are all incorrect reference points. As I mentioned earlier, for services that are performed by GST registered businesses with BEFE in Singapore, generally, yes, 9% will apply. However, should we reference back to section 21(3) of the GST Act, there could be situations where you perform services and those services to our local customer, zero rating could apply. Okay, let's look at this particular scenario. Okay, again, this is a real case. We have also put in the phantom names to protect the identity of our client. Okay. In this instance, put yourself as company E. Okay, company E is providing testing services to a customer who is based in Singapore. Okay, however, due to cost and capabilities, company E do not have that facility and capability in Singapore to perform that service. Okay, company E, upon knowing that customer has appointed them, subcontracted this testing service to its related entity or subcontractor overseas. Okay, and to give you more details, this subcontractor will perform testing service on the mentioned customer's goods and is identifiable. Okay, thereafter, the goods will then be shipped to the end user of the customer, which is located outside Singapore. Or for the support that company E receive from its related entity or subcontractor, obviously they will receive a bill. That is not relevant in today's discussion. But my question back to you would then be, for these testing services that we see on screen, that company E provides to customer, do you think zero rating would apply? Okay, again, in your chat function, indicate as yes if you think zero rating will apply. If you think unlikely because I'm billing a Singapore customer, just indicate as no. Well, I think I probably praised all of us too early. Most of us indicated as no, okay, because of the fact that we are providing a service to a Singapore customer, right? Yeah, no, as the service is provided in Singapore, okay. Again, if you have followed what I shared earlier, okay, just to recap, okay, company E, a Singapore registered company with belonging status, fixed establishment in Singapore, okay, provides service to a Singapore customer, and because company E do not have the capability here, it outsource this to its related entity or subcontractor, and the customer's goods are shipped to the related entity or subcontractor's facility overseas for the services to be performed. Okay, and the testing services, obviously there will be service report, documentation to substantiate that the testing service are done on the customer's goods in that location, and thereafter, after performing the services, obviously this is a arrangement where company E subcontract that work out. Company E will bill customer for the testing service. Okay, I believe most of us indicated as no. Okay, yeah. Well, Albert changed his answer to yes. Okay. Okay. If you looked at this particular segment of section 21.3, particularly section 21.3F, okay, there are two main conditions where the conditions that you see on screen, the two main conditions. First one, services supplied directly in connection with goods situated outside Singapore when the services are performed. Again, if you read this carefully, the key points are services supplied directly in connection. And if you have heard also what Eileen has shared on directly in connection, there must be an identifying goods. We must be able to prove that services are done on that goods itself. Okay. Next, on point one is in connection with goods outside Singapore when the services are performed. In this situation, the testing services are indeed performed outside Singapore, okay, and is in connection with the goods outside Singapore. Company obviously needs to maintain the relevant service reports, etc., to substantiate that. Okay, so we pass that first point. Then the second point talks about the services do not involve promulgation or supply or right of promulgation of advertisement. Okay, so in this case, company E, okay, is not providing any advertising related services to the customer, is providing a testing service. So if you look at section 21.3F, okay, you will satisfy these two conditions, and zero rating would apply or when company E raise that invoice. Okay, I believe based on these two examples, again, I might be wrong. Most of us might not be really very familiar on how to utilize section 21.3 of the GST Act. Again, I'm not sure whether we still have time. Okay, we are slightly overrun. Okay, just to give you one example, I always like to use this example. Section 21.3 of the Act has A to Y. Okay, there are obviously many conditions, but not all will apply to you for your specific service scenario. It's akin to you going to your favorite supermarket, be it NTUC, Sheng Siong, or Cold Storage. Okay, my favorite is NTUC Finance. Okay, obviously, when you go to your favorite supermarket, they have everything on display. You won't buy everything when you go for a particular visit, right? Similarly, when you look at section 21.3, not every point from A to Y will need to be scrutinized. It will apply to your service. You just need to find one segment that applies to your service nature. And under that segment, should we be able to satisfy the conditions? Obviously, it's probably also tough to understand and digest those conditions, but if you are able to digest, obviously through clarification with IRAS, live chats, etc., you'll be able to then get a point where, if I satisfy these conditions, then zero rating would apply. Similarly, on the scenario that you see on screen, although company E is providing a testing service to a local customer, zero rating will apply under section 21.3F by the fact that the two conditions are been satisfied. Okay, I hope this helps. Okay, let me quickly move on. Okay, because I'm slightly behind time. Last but not least, okay, services performed in Singapore. Okay, if you heard what I shared earlier, most of us also thought, for services performed overseas, definitely no GST. Services performed in Singapore, like the second scenario that you have attempted earlier, if I were to perform a service, bill a Singapore customer, definitely 9%. Okay, so for service performed in Singapore, okay, again, I'm using Company F. This is also a real life example. Company F provides storage services to its customer. Okay, and this storage facility of Companies F is located in Jurong Island. Okay, so we have Singapore, and on the other side, designated area. Okay, that designated area is still Singapore land, but it's called designated area for a reason. Or as most of us know, Singapore is a trading hub. So we need to have special areas to allow businesses to be based here so that we can support the economic growth of Singapore as well. So in this situation, Company F provides services to a local customer, and that storage service occurs, okay, in a storage facility within Jurong Island. And these storage services provided covers imported goods or goods which are for exports. So my question then to all of us, for these storage services that Company F provides to the customer, do you think zero rating, i.e. 0% GST will apply? Again, in your chat function, if you think it's possible, click yes. Otherwise, indicate as no. Okay. Okay. This question, I think, is probably half-half. Most of us indicated as yes, zero rating will apply. There are still some of us who indicated as no, just to also show you the condition. And in this scenario, if you scan through Section 21.3 of the Act, of the GST Act, you probably will come to this point called Section 21.3L, which there are two main conditions that obviously Section 21.3 is pretty long, but I have extracted the most relevant points from there. If you can see on screen, prescribed services, okay, services relating to ships and aircraft and goods carried thereon, meaning any goods that are carried on ships or aircraft. So in this case, goods that are imported, definitely they will come to the Jurong Island via vessel, right? Cannot be, well, I do teleporting like you see in the Avengers, right? Cannot be, okay? Yeah, so it's carried on board a ship and it's docked on Jurong Island, okay? Secondly, services supplied within any free trade zone or designated area of a port, terminal, or airport for the handling of goods, ships or aircraft, or the handling or storage of goods carried in any ship or aircraft. That's point 2. Okay, so if you do also agree, because these storage services which Company F provides is relating to customers' goods which are imported, carried on board ship, right? And for goods that are exported, obviously, if you send to Jurong Island, it cannot be exported via aircraft, it must be exported via ship. Okay, so since these two conditions apply, zero rating will also be applicable when we raise that invoice. Okay, so specifically, based on what you have heard from Eileen, Lina, and myself, we are hoping to share with you some of the fundamentals as regards goods, particularly for exports of goods, what are the key areas to look out for, and from a service perspective, to also debunk some myth and to correct some misunderstanding about how to apply Section 21.3. I hope this helps. Again, before I end and move to the next segment, if this is helpful, just indicate in your chat function to say yes. Okay. Well, IRAS takes down the name of everyone who answered wrongly. Okay. I don't think Lina, Eileen, and Cheryl will do that. Okay. Yes, thank you. Thank you everyone for your yes. Okay, so based on what we shared, obviously there will definitely be some of us who may have an incorrect application or based on the export of goods or supply of goods that we have done in the past, as well as services that you have made and raised invoice to. So you need to take action. Again, we are encouraging everyone to take action through tapping on voluntary disclosure initiatives. Particularly, I think if you ask me, I will encourage most of us to consider doing an GST assisted self-help kit review or ASK review on your past year's GST reporting, and should there be any incorrect areas, or do not just sweep it under the carpet lah. I believe most of us, we are a bit shy. Okay? Oh, we don't want to be so high profile. But what if you sweep it under the carpet and there's an IRAS query that comes along? Potentially, you then volunteer yourself and say, oh, we have actually done the review ourselves. It might not fall under the voluntary disclosure initiative already. You could be penalized under the scope of the fines and penalties within the GST Act. So I'll encourage every one of us, okay, be more gung-ho, take baby steps, okay, to run through those areas that we have shared. Should there indeed be incorrect areas, summarize them, take the initiative to go to IRAS and say, these are the areas that we have discovered as part of our sales review. Could you also guide us through and also potentially consider us for lower penalty under the VDP or voluntary disclosure program? Okay, I hope this helps. And to close off, I'd like to thank you for the session, and also like to thank IRAS for the sharing, as well as SPF for organizing this